If you search for ETFs online, you will see endless advice telling you to buy them, but a very few explain what you are really buying and how they actually work. In the next few minutes, we cut through the noise. No hype, no get rich quick promises. Just a clear explanation of how ETFs are structured, why they exist even though mutual funds already do, and a real time look at markets in the US, Europe, and India. Stay till the end. We will break some common ETF myths, and I will share 1% insight that most investors miss, which could save you thousands in hidden costs. So let's begin. ETF stands for Exchange Traded Fund. To understand it, think of a music playlist. Buying a single stock is like buying one song. An ETF is like a top 50 hits playlist. You buy the entire playlist with one click. Instead of choosing individual companies, you buy a pre selected basket of companies bundled into one share. You buy that share on a stock exchange just like Apple or Tesla. So, from the outside, an ETF behaves like a stock, but inside, it behaves like a fund. Now, the obvious question: if mutual funds already do this, why do ETFs even exist? There are two main reasons: tradability and variety. Tradability means ETFs trade like stocks during market hours. You can buy an ETF at 10 am and sell it at 5 past 10 am. The price keeps changing just like stocks. Variety means ETFs unlock far more choices. You can invest in a whole market, a specific sector, a single country, or even particular theme all through one ETF. Some of these options are limited or not easily available in the traditional mutual funds. So, who actually creates an ETF? Large fund companies like Vanguard in the US, iShares in Europe, or HDFC in India. They design the ETF and decide what goes inside it. But to keep things running, they work with large financial institutions called authorized participants. You don't need to remember this name. Just know their job is to add or remove ETF shares when needed, so the ETF price stays close to the value of what it holds. Now, to buy an ETF, you need a brokerage account that can access the exchange where the ETF is listed. For example, to buy an ETF listed on the New York Stock Exchange, you need a broker that can trade on US exchanges. Some international brokers let you do this even if you're not in the US. These were the basics. Now it's time for the Doom Mythbuster, the biggest misconceptions that confuse beginners. Myth number 1: ETFs are always cheaper than mutual funds. Not always. Yes, ETFs often have lower expense ratios than comparable mutual funds like the S&P 500 ETFs versus S&P 500 index fund. That's mainly because ETFs are traded on the stock exchange, which reduces day-to-day operational work for the fund company. But a low expense ratio alone does not mean low cost. If an ETF has poor liquidity, can actually end up costing you more. We will connect this dot in the Do Insider section. Myth number 2: all ETFs are passive index funds. False. The majority of ETFs follow an index. That's what most people invest in. But there are also active ETFs where a team actively picks and manages the investments instead of just following an index. You can see some examples. But in India, it is different. Due to SEBI regulations, ETFs in India are almost entirely passive today. And the next one: ETFs are always safer than individual stocks because they are diversified. Not really. Diversification depends on what the ETF holds, not just the fact that it's an ETF. A narrow thematic ETF, like only AI or only EV stocks, can be almost as risky as a single stock. Now let's get practical. When you search for ETFs, they usually fall into these buckets: equity ETFs, bond ETFs, sector ETFs, commodity ETFs, and thematic ETFs. Now let's make this real with live examples. I use TradingView as my global ETF screener, though you can use many country-specific apps for deeper analysis. When I look at any ETF, I'm always checking these 5 things: price, the cost for one single share of that ETF; asset under management, this tells you how much money is in the fund. Higher usually means more popularity and better liquidity; expense ratio, your annual cost for owning the fund; performance, the historical gains over 1, 5, and 10 years; asset class and index, this tells us exactly what the ETF is tracking. Let's start by filtering for the US market. If we sort by asset under management, it's no surprise that S&P 500 ETFs are at the top. You will also see total stock market ETFs, growth ETFs for higher performance, and value ETFs for stability. Let's focus on the S&P 500. We have Vanguard, iShares, State Street, different fund houses, but same index. Notice something important: expense ratios differ slightly, but performance is almost identical because they track the same index. That's how index ETFs work. By clicking on the ETF, takes you to the detailed overview page. But for absolute accuracy, always verify details on the official AMC website. We will do a deep dive into fund analysis in another video, but let's look at the portfolio composition here. If you scroll down to weighted exposures and see the sector weight, information technology currently has the highest stake at 34.6%. If you scroll further, you can even see the individual names of all 504 companies in the fund. This is how you verify what you are actually buying. Let's head back to TradingView and change the filter to Germany. You will see the same S&P 500 offered here by iShares following European standards and priced in euros with a slightly higher expense ratio. But look at this performance gap from last year. It's a major lesson. If you invested in the S&P 500 from the US, you saw a return of around 16%. But if you invested from Germany, your return was only about 3.5%. Why? Because the US dollar weakened more than 10% against the euro last year. Even when the index performs well, currency movement can change your actual take-home profit. Finally, let's look at India. Unfortunately, TradingView is not up to date with Indian ETF data. You can see a list of ETFs here, but asset under management is often missing. Because of this, let's switch over to a local screener like Grove. Here, we will filter for the Nifty 50 and open the SPI Nifty 50 ETF. If we scroll down to the comparison table, we can see other fund houses like UTI and Nippon. By sorting through asset under management, you can see SBI maintains its massive popularity with an asset under management of over 2.17 trillion rupees. You can also see how the expense ratio varies while performance remains competitive across the board. Alright, let's move on to the final part of the video, Do Insider. The key information which most beginners miss it. The real cost of owning an ETF is not just the expense ratio. It is expense ratio plus trading cost plus tracking error. Expense ratio, like you already know, the fund charges you every year. Trading cost or spread, the gap between the buy and sell price. Tracking error is how closely the ETF follows its index. A large tracking error means the ETF quietly underperforms. A cheap ETF with poor liquidity can cost you more than a slightly expensive but liquid ETF. Here is a simple rule of thumb. When comparing similar ETFs, always prefer high liquidity or high asset under management, low expense ratio, and low tracking error. That single choice can quietly save you money every time you invest. If this helped you understand ETFs clearly, hit like and subscribe for more such insights. See you in the next one.